Netflix has just released their earnings and the stock has jumped up massively to $984 a share. This is their Q4 earnings for 2024, and we have all the numbers that we're going to go through right now. So, as we can see, revenue has grown 16%, operating margin expanded 6 points to 27%, operating income exceeded $10 billion for the first time in their history. Revenue has increased 16% year over year, and this has been helped by 19 million paid net ads, while operating income rose 52%. We finished 2024 with 302 million memberships. Talking about Squid Game, talking about Carry On, actually watched it, it was okay, I think that's fair. Jake Paul, Mike Tyson fight, and obviously they've had NFL games. This has been a big year for Netflix. 2025, they want to improve their core business with movies and film series, enhanced product experience, and the growth of the ad business. New initiatives such as live programming games, healthy growth, 43 to 44 billion, and they maintain their leadership in position in engagement, revenue, and profit. So what does that mean? Well, let's just have a look at the actual numbers here. We have Q4 23, Q1 24, Q2 24, Q3 24, and the Q4 24, and they also have a forecast here. But revenue for the quarter, all-time highs, 10.2 billion. That's year-over-year growth of 16%. Operating income, 2.27 billion. I might have said million before, 10.2 billion. Operating margin, 22%. Net income, 1.8 billion. Diluted earnings per share, $4.27. This is the global streaming paid memberships, 301 million. That's 15.9% year over growth. And in this quarter, best quarter ever, almost 19 million paid members. Free cash flow down here, 1.378 billion for the quarter, and then shares 437 million. So looking pretty good. What we're going to be doing today is looking at my automated stock valuation spreadsheet, putting in these numbers and see if Netflix is a buy or sell using the discounted free cash flow model, comparable company model, and the Ben Graham formula for intrinsic value. So if we go to here and put in the ticker Netflix, NFLX, this will load all the company financial data. But what we can do here is we can override the latest numbers, which we do have. If you're interested in this sheet, check my Patreon. Links are in the description. We have a growing community here, and people are pretty happy with the sheet. So here we are. We have Netflix. Obviously, as we saw before, $980 a share. Much higher than 371 billion market cap now. PE ratio of around about 49. This will be increasing. Market average is around about 30, so higher than the market average. Earnings per share $17. Beta 1.27 means more volatile in the market. And analysts currently have it as a target price of $873, which means it is broke through that pretty easily. So here we have the numbers here, but what we will do is we'll add in the previous numbers. We saw that the revenue for the quarter was 10.247 billion, and you can see that increased the total revenue there to 39 billion. Next we have net income, just shy of 3 billion, which brings the net income to almost 10. And the free cash flow, I believe, was, oh, actually, sorry, it wasn't 294, it was 2273. That was the projected number. And free cash flow, we have 1.3 billion. So free cash flow actually is down slightly, but you can see a massive increase. So let's have a look at those revenue numbers. All-time highs, 39 billion in the trailing 12 months. Exponential growth, pretty consistently. People were wondering if they could continue to do it as the Kanye meme goes, but they have here. You can see it's grown past the sort of quote-unquote, well, not down year, but slightly decreasing years since the pandemic year where they had a massive jump up and still managed to do it. But yeah, the growth has been pretty good. Net income, all-time profits, 9.12 billion. Free cash flow, just shy of the all-time high, 100 million down, but 6.92. Operating cash flow, we don't have those full numbers yet, but you can see here that the operating cash flow for Netflix is increasing. In fact, actually, we do have the numbers. If we go back to here, down slightly, but in the trailing 12 months, this will be all-time highs once again. So let's just have a look at the, 1 second. Shares outstanding, they were buying back shares recently. That is good. They're rewarding shareholders. Okay, let's have a look at the discount and free cash flow model. This is a way of valuing stocks, looking at future free cash flows and discounting them to today's value. Currently giving us minus 41, but this is taking the averages. As you can see here, the free cash flow rate is a minus. So we'll take their most recent number, which put us at about, let me just see, we have that at 6.9 billion, yep, which we do. So we'll put the free cash flow ratio at about 75, or free cash flow rate. That brings us to $300 a share. Next, we'll look at the net income, the revenue growth rates. 42, 45 billion. Let's see what analysts are saying. 43 billion. So I think we'll be a bit more bullish there. Oh, well, if we look at the most recent quarter, I suppose 36. Still just shy of $400. Net income margins, I think these have been increasing and continue to increase. So we'll put this, be the bullish case, 23%, $500 a share. And that is, yeah, so that's everything there. So discount free cash flow doesn't really like the stock, but for a high growth company like this, with sort of a very high free cash flow ratio, it was never going to like it. Ben Graham, formula for intrinsic value. I'll quickly go through this. Ben Graham hates all the stocks at the minute because of the 5.2% AAA corporate bond yield. But Netflix is expected to grow at about 20%. So if we say 21, still $400 a share. So Ben Graham does not like the stock. Finally, we'll have a look at the comparable company model. This is a way of valuing companies, looking at their competitors in similar industries. And I have a few here that I want to look at, whether I've just lost my sheet. The companies we want to compare to are, I think, Disney, ticker symbol DIS. We'll do a few here. I want to do the top constituents of the S&P 500 as well. But we'll do sort of more similar companies here. We'll do Disney. We will do WBD, Warner Brothers. We'll do a few here. And we will do, can we do Para? And what this will do is it'll load up all the company financial data so we can have a compare. So interestingly here, unfortunately, Warner Brothers and Para are not profitable at the minute, so we can't do that. So that kind of shows the state that Netflix is in, is it's pretty good. PE, about as high as Disney. Profit margins, look at the profit margins, 23%, much higher. Revenue, highest enterprise value. Big revenue growth rates, but not as high, surprisingly, as Warner Brothers. Discovery, most profitable, highest margins. Pretty low PEG, which is Peter Lynch's price to earnings growth. And it gives us pretty jacked up value. So what we'll do now is we will keep Disney. We will look at Amazon, ticker AMZN. And we'll see if Comcast also has it. Yeah, okay, cool. Well, what we'll do is, well, I'll open up the S&P 500 constituents and who is sort of their closest competitor in there. Netflix are, okay, they're only top 20. Well, they'll be a lot higher now, obviously. But yeah, okay, fine. So looking at the metrics here, EV to revenue is the highest. EV to EBITDA, middle of the pack. Comcast really brings us down. In fact, we're going to take Comcast out. We'll just compare Disney and Amazon. Still puts it $500 a share, quite interestingly. Lows of 360, highs of 800, pretty all over the place. But the the PE number is where it's actually liking it, because it is sort of about the same as Amazon, which is quite interesting. So overall, very good earnings from Netflix. Price is still going up, 997, almost breaking $1,000 a share. If we look at the 5-year chart, all-time highs continuing. Well, yep, all-time highs. There you go. See, they were at all-time highs at the start of December. Dropped down a little bit, but they have breached that once again. So heck of a stock, heck of an earnings, and it'll be interesting to see what they do next. Right, guys, thanks for watching. Please give a like on the video if you haven't already. Subscribe if you're not, and I'll catch you guys next time.